Drew Meredith. How you going?
Very, very good.
It's good. Very good. Two varies.
Always, yeah, very, very good.
Fair enough. What have you been doing?
It's better than I ask my kids all the time how they are. They're like, good.
That's good.
Give me something more than good.
Yeah. No, that makes sense. If they're good, they're good.
Yeah.
Um,
Bit of excitement. Lots happening. It's always good.
it's always good. You've just been away, so you're rejuvenated.
Which is nice.
Yeah. Today we're going to be talking about. I've got some questions about
Not golf.
no golf today. A fellow in our community has just given up cigarettes and has taken himself from debt to no debt, and now looking to invest. We'll cover that. We've got some questions about the Premier Investments Myer thingamajiggo that they're doing.
We do.
The Sigma plus Chemist Warehouse thingamajiggo that they're doing, and what those basically mean to people. But we've also got some updates. President Trump has announced a tariff on Drew Meredith.
All exports of Drew Meredith.
And now it's been undone.
Yep. Reversed, yep. I coalesced to the requests.
Yep.
That was super interesting. Like we talked about last week, it was DeepSeek. This week, it was Trump. Yep. I think it all happened over the weekend, almost as we were recording last week. But he quickly came out and announced 25% tariffs on Mexico and Canada, so two of their biggest trading partners, on a big range of products, and using it as we've known from Trump, he always goes incredibly hard, and he's using it as a tool to negotiate. And he was asking for changes to their border security rules. Mm-hmm. So the tariffs for those two countries were quickly delayed. But after the executive order, and basically because they agreed to change their border policy at the moment. Right. So he got what he wanted very quickly, but who knows? I can't see this stopping, and it seems like he's one of those people who negotiates by just putting it out there, putting it in place, and then dialing it back. How do you set a negotiation? By going incredibly hard the first time and
seeing what happens next,
or don't dial back at all. He doesn't usually dial back at all.
We had
not so lucky though.
We got this question. I mean, we get a load of rubbish on the YouTube channel. Let's be honest, but we had this question. I'm going to see if I can find it. Basically, something to the effect of, "What's everyone going to do what happens if the government," that's what it was, "puts the same capital gains tax thing that they're trying to do inside super on investment portfolios outside of super?" So for people that aren't familiar, the government is proposing to tax unrealized capital gains. What that means is, if the value of your investment, like a property or shares, goes up from this year to next year, you will be taxed on that gain, even if you haven't sold it. So even if you don't have the cash to pay for it.
If your balance is over 3 million.
Yeah, but this person was like, what happens if they do that outside of super?
I mean, it's a slippery slope argument, isn't it?
Well, then I think it's just, let's just come out with the dumbest thing we can possibly say, so then the next thing doesn't seem as dumb.
It's finally being covered again. I know the Fin had an article this week, but these issues are finally being covered. And I was pretty opinionated on this. Me and James did a episode on the retirement podcast, and then I did a video for YouTube on it. And it's like it actually probably makes investing in shares more attractive if I can't. Hopefully, it never happens, but being taxed on unrealized gains. It makes investing in shares more attractive, or anything but property, because it's hard to sell a bathroom. I'll say this all the time. And if you're getting taxed on the increasing value of your property every year, you're going to have to come up with cash. Not saying it's going to go through, nor should it ever. I mean, what tends to work better and what has historically worked better is a quasi means testing of superannuation benefits. So, if your income is above $80,000 in super, you should pay tax on the income above that. Not let's tax something you don't even really have, like you have on paper, but you haven't realized, and completely flip all the taxation law. I think the other problem that we pointed out at the time on the $3 million cap, which I think that's the main topic, but was the issue that it's not indexed. And we know bracket creep we've talked about forever, because the income tax brackets weren't increasing. So what will only impact 0.5% of superannuants now is likely to impact 500,000 people at some point.
Yeah, that's the problem with all this stuff, right? And so that's why I kind of have this. I wrote in an email a few weeks ago, and I got a lot of feedback, good and bad. I wrote in a Rask email, which goes out every Sunday morning. If you don't already have your Rask account, it's free and you get the weekly newsletter and a bunch of stuff. Go and hook yourself up with that at rask.com.au/free sign up. I wrote in the email that if I was under 45, I would not be putting more money in super than what my employer does.
Yeah.
People are like, oh, just put money in super. I wouldn't do it. No way. Not at 45. It's 20 years probably before you'll be able to access it. And the government's going to get its Winnie the Pooh fingers into that pot.
Don't judge Winnie the Pooh.
No, he's great. You've seen the quotes. But I just wouldn't, because under 45, if you've got the government guarantee and you've got a decent job, you're getting 11.5% of your money going in there.
You're going to get there anyway.
You're going to get there because it's going to, if it is invested well, just pick a good super fund.
We talked to a lot of people entering their early 50s or mid 50s, and that's where you can start.
Yeah, that's start to do it, because then the distance from you and the money isn't that far away, right?
Because you can access it sometimes from 60.
Yeah,
as it stands at the moment.
Particularly if there's a couple, then one might be younger, one might be older. It brings up like recontribution strategies and all that sort of mumbo jumbo. Motivational Flavio. I'm pretty sure this wasn't a scam post on YouTube, which would be a first. They said, team, I still...
the leading crypto trader.
Yeah, Mr. Jeffrey gave me really good return. This person on YouTube said, team, I haven't got an answer on the previous video. You invested in the Munro Small Cap Fund, but I can't find that fund on any broker. For anyone that's watching, I'll show you this. For anyone that's listening, I'll walk you through it. So in our 3 portfolios that we made at the beginning of this year, if you go back and listen to the first episode, we've got the 3 portfolios. We've got the community portfolio. We've got Drew's portfolio, which is called Everything portfolio. And my one,
Master Foods, Everything Eggs.
Everything Eggs is for context. Mine is called This Is the Best One, because Monique, our podcast manager, chose that. And the community portfolio is called Dizzy Rascals. But what happened in that, Drew and I didn't swap notes beforehand, but when we got into it, we both realized that we picked the same fund to put in our imaginary portfolios. And that fund is the Munro Global Small and Mid Cap Fund, Munro Partners Global Small and Mid Cap Fund.
Growth, yep.
Which goes under the symbol GSF0874AU.
So this is a managed fund, or what's a unit trust, which means that's an APIR code, which means it has to either be bought, it can't be bought on the share market, has to be bought via an advisor or directly via an application.
Yeah, you go to the Munro website if you don't have an advisor. But that, when you see a long, complicated code like that, and it's not like ASX or NASDAQ or New York Stock Exchange, you have to go direct. And I asked Chow Ma, who's the portfolio manager of that, when she was on the show a few months ago, I asked her, would this ever be considered as an ETF? And the reality is they just can't do it because it's a small cap fund. You'll notice that there's no real good small cap ETFs. And because if you're a small cap investor, liquidity becomes an issue. You can't buy and sell as many shares as you would want.
Yeah.
Even in global smalls, it can be a little bit dicey. So they don't allow you to invest that way. That's why you typically have to go direct. But let's just do an update while we're here on the portfolios.
I tend to, so this is, again, not a core portfolio. This is our kind of swing for the fences portfolio. Yep. But if you're building a small cap exposure, you can get an index exposure like we'd look at a core satellite. But the problem with that is because it's in an ETF format, it's always going to be in the larger end of smaller companies and not necessarily the exposure that you truly want. Hence why we'd blend that with something like Munro.
Yeah, you also put in your portfolio the Yarra X20 fund, which is the one run by Dion Hershen, who we had on the podcast, thanks to you and Jamie not too long ago.
That's right.
That's an Australian mid-cap fund, mid and small cap fund. So that's another one that's not available as an ETF, but you put it in your portfolio, which we're tracking via Navexa.
Let's just have a look at Pro Medicus there.
Pro Medicus up 15% already since you recommended it to everyone as a strong triple down, inside out leverage buy alert.
We're not allowed to adjust these either. We just have to.
You have to ride or die, baby. So you picked Pro Medicus, which I'm just checking is now $287 a share.
I said when I when I suggested this, that it was a company I'd never felt the confidence to buy. with my own money. So spending fake money made me much more confident. And I'm going to claim a win on that.
That's pretty good, my man.
Yeah.
You look at this share price.
It's only going up.
It's up nearly 23,000%.
Like residential property, only going up.
It's now a $30 billion company, PE ratio 360, dividend yield of a cool 0.14%. This, for people that aren't watching, if you just Google ASX space PME, which is the Pro Medicus thing right now, just pause your player and come back with some shock and awe. That thing is just unbelievable.
Share price was initially 2 cents. It makes it easy to have a good chart.
Whoa, that's like, wow. Wait 1 second. I'm just going to check to see how much I've made on this puppy. Okay, so I'm up 4,000% since my purchase price.
Credit to you.
Thank you, good sir. Humble brag, not really humble. Anyway, back to our portfolio. So you are up 1.45%. I have not looked at any of this. I'm up 2.91%. What's weighing me down? XRF. Bloody hell, XRF.
Oh, that deal fell over with Seek too. We won't.
Get up.
It wasn't in our list
Bloody
today.
thing. Dizzy Rascals, the community portfolio, is it's a sinking ship. It's only up 1.87. So 2.9 to myself. Oh, actually, Drew's 1.45. What's weighing you down?
The tech stocks I went into.
Oh, Tesla, Nvidia, both down 7 or 8%. Not too bad though. Yeah, that'd be right. Dizzy Rascals though. Whoever picked Vulcan Energy, yikes.
The dome.
Whoever picked Vulcan Energy, the lithium explorer / thing.
We shouldn't laugh because they probably invested into that as well. I think this is a story of, like, for me, particularly, why would I suggest holding a managed fund in this portfolio of investments and a diversified, is because this is what can happen in small and mid-sized companies.
Yeah.
Volatility of an individual small cap can be massive, and that's down 22% in like 4 weeks.
Yeah, 4 weeks.
So that's why if I'm even personally or for clients, I'm always looking at adding diversification in that sector, and the ability to, reduce the risk of something like that happening.
And if you're absolutely Drew, same here. If you're any type of investor, Vulcan being some commodities play type thing is not the thing that would ever go in a core portfolio. Obviously, we've said it 100 times, but these portfolios are just a bit of fun. They're not at all how Wattle Partners would invest, and not how I invest. But yeah, that is like that's the downside of having one of these positions. If you had 50 stocks in your portfolio, a 2% weighting in Vulcan you might think, okay, that's fine, I'll take the risk. But obviously, we only had 10.
Yeah.
I had a lot of rubbish to contend with, Drew, when I was putting together the community's portfolio, if I'm being honest. Like we said to people, shoot for the stars, and they definitely
shot.
They were going into the Andromeda galaxy, mate. They were just going, all right then. So I definitely had a bit of a strong filter on, and Vulcan's probably the one that I let slip through, which I probably shouldn't have. So
paying for that one.
Everyone in the community that contributed to the portfolio is probably like, who the heck recommended that go in the portfolio? Where are they? They're probably out there hunting for them with pitchforks.
Take a reverse course a little bit. So,
well, maybe you could do the opposite, And my double leveraged ETF on the US market, GGUS, yeah, boy, that's going all right.
KKR.
Kev's
GGUS doing well, and Nvidia and Tesla aren't.
Diversification, mate. Look it up, mate. Diversification. Anyway, back to reality. So
Nvidia up another 300% growth quarter, and then we'll be fine.
You'll be right. You'll be back on track. So just to come back to reality for a second. So yeah, the way you invest in those types of managed funds is directly or through a financial advisor. That's just how you do it. So keep that in mind. Drew, what else was making news this week?
We had a couple of mergers, takeovers we were going to pick up on. I think we missed them last week, which was super interesting. Not companies that we hold, but it's like an interesting insight into what's happening in markets.
Yeah.
Seeing a dearth of IPOs still, like private equity and all these groups are struggling to get new companies listed on the share market, despite being all-time highs. But the Sigma Chemist Warehouse deal has finally gone through. Apparently voted on at the Olympic Hotel in Bell Street, Preston, or Bell Street, Coburg. There was a big story about that too. So
is that where either of these companies is found?
I'm not sure.
Coburg's a suburb just north of Melbourne CBD. It's
I'm pretty sure
it's good.
Veronica,
kebabs and whatever there.
one of the long-term owners. I think maybe both long-term owners are Melbourne from Melbourne.
Right.
But it was at a kind of random hotel. I'm sure it has meaning to them. Maybe it's where they came up with the idea of building it, and it would make sense. But the deal will see Chemist Warehouse essentially fold in or backdoor list into Sigma Pharmaceuticals. And this relates to a question that came through as well, which shows you how complex markets can be, is that Sigma was only worth about a couple $100 million in shares, and the combined entity is going to be something like $6 billion on the share market. So how do the machinations of this work in the background? But basically, Sigma will be issuing issuing a whole heap of new shares, and I think it was $700 million in cash to purchase Chemist Warehouse from its current owners. That would see the current owners of Chemist Warehouse own something like 87% of Sigma shares once listed. So what you'll see, you would have had the chance to get into some sort of capital raising. I'm assuming or hoping, but you'll be significantly diluted in the number of shares you have, but you will have exposure to a much larger, stronger, and better business.
Definitely a better business. Yeah. I've actually managed to dig up a photo of the Olympic Hotel, Drew. Here we go.
Say it. I think it's on the corner of Albert Street and Bell Street.
It does a bit. It's got Keno. It's got Tab. It's got the kids zone and pokies.
I'm guessing. Look at that soup. Looks delicious.
It's a bit of bread, bit of a dinner roll there for people that are interested in their stocks.
I'm guessing this is probably where the original deals kind of came from.
Yeah, it's got to have some meaning because, yeah.
No, come on, don't judge.
I mean, it would be a flex if they're like, yeah, we own this pub, so we just thought we'd do it here. But yeah, ultimately, Chemist Warehouse is a better business than just Sigma by itself.
Better, for sure.
And there's a lot of lot of commentary. There's obviously like a bit of a memo that you can read about in the filings as well in the ASX that tell you a lot about the business, how Chemist Warehouse has grown over the years. And a lot of people, a good one would just be going to visit the stores. If you haven't, you probably have already. And speaking to staff, it's a very particular culture at Chemist Warehouse, from my understanding, speaking with staff. But if we think about some of the recent IPOs, it's not really an IPO. It's kind of like a reverse listing type thing. I'm sure there's a fancy word for it. But, Guzman last year and then this, it's actually not like there's been some good mid-sized companies come to the ASX.
There's not a lot.
Just not a lot. And that's typical in a harder environment for markets because you typically only get the deals that actually can push ahead and push through that and actually have proper demand. Because in 3 years ago market, you would have had, if you had an idea, you could IPO for $400 million, So it's a bit different now.
Yeah.
But there is another corporate actions going on the ASX recently, which is from Myer and Premier Investments. And the gist of it is that Premier Investments, which owns Smiggle, Peter Alexander, JJ's,
Just Jeans,
Dotty, Jackie E, Portman's. Basically, what Premier Investments has done is Premier Investments owned a chunk of Myer. And they've basically said, what are all the worst businesses we have? Let's give them to Myer.
They actually said this, but...
And then Myer's like, oh, okay.
Okay.
Yeah, exactly. And then, that's just what happened. And so basically, that's what it seems to be.
Right.
It's like synergies. And I mean, if you can combine a bunch of mediocre businesses, you might get some magic. So maybe put that over there. But I must say, I say that in jest somewhat because the big dog, Solomon Lew, who runs Premier Investments, a fantastic operator. Obviously, it's unquestionable. Is going to be a major shareholder in the Myer entity after the swap. And basically what Premier Investments is going to be left with is the three darlings in its stable. You'll have Peter Alexander, you'll have Smiggle, which is the kids accessories and type thing. And then you'll have its stake in Breville. So Breville being the appliance maker, which is actually a wonderful business. A lot of people question how that thing can be so good operating overseas. But all three of those businesses have international exposure. and really are the growth drivers of Premier Investments anyway. So to have them together is really key. And
Myers
then
shares to buy.
yeah, and then Myer on the other side, the new Myer will get all these kind of apparel brands, which they call it.
I do remember you bought all those Hawaiian shirts that we traveled around the country.
That was from
Just Jeans?
Just
Or
Jeans. They were
JJ's,
pretty good.
yeah.
Yeah. If you want a good Hawaiian shirt, go to Just Jeans. Don't know yeah, I feel like they would still be there.
They were pretty good.
They weren't bad. I had a weird rash afterwards, but who knows? I was also in Noosa, so
The deal's not closed yet, so
no, just seriously, it's all good. So that business actually, there is. I kind of joked before. Where I said you just get a bunch of random businesses, you chuck them together, see what happens. But if you do have a lot of those kind of heavy industry businesses like fast fashion and those types of things, they do require a lot of distribution effort. There's a lot of synergies that can come from web traffic, from even floor traffic. Like if you've got some of those Myer buildings, many of us will know the big department stores are dead, and they have been for a long time. But maybe there's synergies there in terms of not having to pay Westfield as much. And so there's a lot of opportunity there. But ultimately, there was a question sent in.
you're going from zero, how many, to like 50 stores to 800 stores.
Yeah. I mean, I'd imagine that a lot of the businesses underneath Premier Investments were operating as their own businesses anyway. So the shift probably was not that big of a deal. But Mr. Smiggles wrote in and said, what has happened to the Premier Investments share price recently? I read something about a distribution of PMV to PMV shareholders, PMV being the ticker symbol, associated with the deal with Myer. As a Premier Investments investor, will I be getting a cash payment or issued shares? So my understanding is you will get something that sounds very confusing, an in-specie capital distribution. So if that sounds like gobbledygook to you, it's because it is. Basically, you just get the shares. You just get some more shares.
You now own Myer.
Yeah, congratulations.
Proud owner of Myer.
And the other thing is you also get an in-specie dividend. So they could have just said dividend. But that is kind of the mix that's going on there. All the documents are lodged on the ASX. Go to the official source documents. The other thing to keep in mind is that Solomon Lew is going to be the major shareholder of Myer, I believe, which is probably a vote of confidence for that business as much as the other one.
I mean, he's been apparently kind of quietly making big calls, and not quietly at all.
Right, well,
putting pressure on from the board for some period of time. So now it's probably just more clear.
Yeah, exactly. Now you know what really been wanting. I would go like, what if you had a choice of those two businesses? So like you've got Myer, JJ's, Just Jeans, Dotty, and Jackie E. Would you rather that business, Drew, Smiggle, Peter Alexander, and a bit of Breville, but you have a 5-year view and you can't sell and you just have to cop whatever valuation you get in whenever the deal settles?
I'll take Myer.
Really?
Depends on the value. I can't see those businesses being sold at incredibly high valuation, but I know that Smiggle, with its recent growth rate, Peter Alexander and their expensive pajamas, are all highly attractive and considered higher quality, and hence probably justifying higher multiple. So maybe on a 5-year view, cost of living pressures, better back office and admin. I mean, I love those brands and they're great brands. So basically, you're getting 7.2 shares in Myer for every Premier share you owned, plus a $5 dividend, a $5.60 dividend. So your share price would have fallen by that much, and you would have, or something similar.
Yeah, and so what's the Premier share price right now? I'll just quickly bring this up live. $24 is what it is now, but there's another reason that it may have fallen recently. So it fell earlier this year from 25 to 20. But there's another reason why they've faced a little bit of pressure, both Myer and Premier, is that obviously it's a tough retail environment. So there's been a bit of downwards pressure on that, but really it all just hinges on this deal that they've got going ahead. So ultimately, I personally, you didn't ask me, Drew, but I would say I'd prefer the higher quality business, to be honest. I'm a bit less sensitive to valuation, can handle the revs going up and down. We did have some great questions that come through, but there's two in particular here, and a nominee for best questioner of the year, and they've self-proclaimed that as well. So before we answer any of these questions and get further into question time, it's important to understand that we do not know your needs, goals, or objectives. So any of the information that you submit in a question and questions that we answer is strictly general in nature. And that means you should not act on the information you hear in a Rask podcast before you get financial advice from a financial planner like, say, Drew here. It's really important because if we talk about something like ETFs or super funds, there may be strings attached to that. So, for example, I would never change super fund unless I've considered my insurance, which is held potentially through super. There's way more to it than just the simple things you might hear on a podcast from time to time. So make sure you understand what you are doing before you do anything. And if we do mention super funds, ETFs, shares, just remember that those things have product disclosure statements, and shares can be risky. You can find out more by reading the Rask Group Financial Services Guide found at rask.com.au/FSG. Killjoy Bond Boy says, "Why am I like this?" I don't know. No, they go on to say, "I've been investing in shares since 2020, achieving a return of 13% per annum. At the same time, I set up a fake money portfolio using Strawman. Hello, Strawman, our friends at Strawman, which has outperformed with an 18% annual return. I know I can be risk adverse, so I used the fake portfolio to test a thesis I wasn't comfortable with. My question is, how do you maintain conviction and consistently invest real capital? Is it just practice and sticking to your framework? I'm frustrated seeing my real portfolio being beaten by my quote unquote fake money portfolio. Firstly, a disclosure, I'm a very small shareholder in Strawman, and I think it's a great website. So go and check it out if you haven't already for individual share investing and small cap investors. Second of all, Drew, how do you maintain conviction?
I mean, the most important thing is understanding what your objective is when you start this process in investing. And far as I can tell, you've got an objective that you're comfortable with, and you've got one. And then, I mean, this would happen all the time. You're more like risk taken well can lead to better outcomes, but the experience and the emotional impact can be the biggest thing that impacts. And I think I wrote an article about this recently, which is that we always worry so much about a market fall, but what we need to worry about is how we're going to react to a market fall, not the market actually doing it. And for us, it's very simple. It's, what are your objectives? Where do you want to be in this certain period of time? Do you have an income objective? Do you have a growth objective? And to define that and be clear and constantly report back to it. That means you don't stray from that strategy and that framework. And once you've got that, it's all about reviewing it and making sure the asset and the portfolio you're building is actually fitting the objective that you have. So if your objective is to generate 30% returns every year, you're going to have a very different portfolio than if it's, I want to get the average return of the last 50 years, which is more like 9 to 10%. And I want to get in the smoothest way possible, or I need to get to this savings point at this point in time. Is a much more attainable objective, and then you can model it out and test it and try different things along the way. But it's all, if you don't have an objective and you're not sure how comfortable you are in different environments, then you don't stand a chance. Because it's just every risk. I've seen it that many times myself. The first time you hit a crisis, you end up selling, and you probably never go back in because of the experience that you had. And then it's about this old word of compartmentalization, isn't it? I just get rid of the fake money portfolio and be more focused on the framework that you have. So we'd have every new client we talk to, we'd do like a one-page investment philosophy or an investment policy that says things like the maximum we'd ever have in a company, that the strategic asset or the asset allocation will use, the investments they won't invest into, and be clear and agree on that at the beginning, which you kind of need to do with yourself if you want to be self-directed, and put that level of structure around it. And you've got something to fall back on consistently.
No, that's a good point. It's quite interesting, that investment policy statement. I think a lot of people can do that for themselves. Right. If you're not ready to see a financial advisor just yet, it's just write down like a series of rules that you have for yourself. We did a thing about 3 or 4 years ago called a DIY investment plan. If you Googled it, it'll probably come up. And just a series of questions and a PDF that you can fill in and keep for yourself. Ultimately, I think that this person, have no idea, obviously, who they are because we don't know. It's all anonymous when they give us great names like this. I think that this person has done exactly what I would recommend to every single one in the Rask community, every single person out there that's new to investing to do, which is that have the money sensibly invested. Just copy like our portfolio, which is available online, not the fake, not the fun ones, the actual ones. Just Google Rask Invest Portfolio or ETFs or something, whatever, something sensible. But then I would spin up a fake account like they've used Strawman. You could use Navexa, you could use ShareSite, you could use some of the apps allow you to create fake portfolios like Watchlist. I think Selfwealth does it too. And I would set one of those up, and I would just run that as a test. And if you don't want to do that, they used to. I don't know, Drew, if you would remember this, but people used to do something called paper trading.
Yeah.
It was this idea that you would, because at the time there wasn't technology to test your strategy. So what you would do is you'd have like fake money, and you write down your portfolio on a piece of paper, and you would track that portfolio every few weeks or months. You would check the price in the newspaper, and you would see where is it going, what's it doing, did I do well, why did I buy this, should I sell that? And then at the end of the 3 months, 6 months, or year, you then go, well, what did I learn? How good am I at investing? Fortunately, you've got these digital tools which will track it for you automatically. But I think starting that way is the very best thing to do, because most investors, and particularly the older men, never find out if they're any good at investing because they don't actually use a tool to track their performance.
And exactly.
They
Most
just think dividend equals good.
Yeah, they have never. When we plug it into our system and back test it, it's like you've so overly exposed. You've actually underperformed the benchmark by 5%, but you can't. If you go and tell them that,
Yeah.
they just you get
Your blood in the streets.
told what to do
Yeah.
pretty quickly.
Yeah.
But there are more and more tools. I mean, and I would step back. I missed this. You've got to return at 13% per annum over the last 5 years. The average return from the share market is more like 9%. So
Yeah.
you've done exceptionally well, and your assets be worth half, more than half more than what they were when you started investing. So like,
It's been good.
Yeah,
It's been good.
and this
Yeah.
isn't normal. You started in 2020 when trading basically took off as a pastime.
Yeah. And you've stuck with it. You stuck with it through the down market, and then it's come back up a bit. So I think this person's really, really on the right track in terms of being
Sure.
sensible about how they're thinking about things. In terms of staying the course and having conviction, the most important thing, and the thing that Strawman forces you to do, which I like about it, is it forces you to have something to back up why you're making an investment. So, because you get a lot of those forums like Hot Copper, which is just people pump and dump and just putting some absolute drivel into the forums. But if with the difference with Strawman is that you have to put a thesis into the like, even if your thesis is like, I like to shop at Smiggle, therefore I buy Premier Investment shares. I put $1,000 in.
Yeah.
At least it forces you to crystallize your thinking. And we had John Addis, who quoted Joan Didion on the show 18 months ago. Joan Didion's famous writer said, "I write to think." And it's very powerful. It's no coincidence that the world's best investors are also phenomenal writers.
Yeah.
Like if you look at Warren Buffett, Howard Marks, like everyone is just, Morgan House is a great writer, right? He's just obviously an index investor, but J.L. Collins, like all these wonderful people, Charlie Munger, absolutely wonderful writers, because the writing is the process of having clarity in your thought. And as an investor, that's what you need to do, because you've got so many different priorities. And so once you write it down, you can have your thesis. And then if something goes wrong in 3 or 6 months, so say you get 6 months in and the company issues a half-year report, Drew, you could be like, well, this is actually, in Pro Medicus's case, I could have been, which I did do a thesis for our investors. They paid $7.45, by the way. I wrote down like why you would buy this, because the Mayo Clinic had just started using it. More US hospitals were signing up, and they'd never lost a tender that they went for. That's a very strong sign that hospitals want to use their software.
Yeah.
And the pricing model was, well, you pay per exam with Pro Medicus. So you pay for the software up front. It gets implemented. It's very low cost, relatively speaking. But where they make their money is per exam, per radiology image, per whatever. And so you could see that thesis play out over time. And even though the share price went to the moon pretty quickly, the share price could have gone down, but they could have stuck to the thesis and still won hospitals, still got more exams, still done all of that. In which case you would have gone, well, yeah, the share price is down and I put $5,000 into it, but it's still doing all the things that I want it to do. The cash flow is going up, the dividend's up. Who cares what the stock market thinks? The business is growing. It's doing exactly what I thought. I'm going to put another $5,000 into it. So that's how you build conviction through fundamental investing. And that's how you ultimately, if you are stock picking, you have to behave. If you just go into it willy-nilly, you're like, all right, finger to the wind, which way is it blowing? You might get it right and think you're a genius. I read about this on the weekend. You might get it right and think you're a great investor, like God's gift to stock markets. But then if the stock price goes up, you don't learn the lesson because you think it goes up just because you're good, but you haven't actually done any research. So then what do? You put another $5,000 into a shitty company. Now you've got $10,000 on the line, still don't know what's happening. It crashes. Then you tell your kids all stock market stuff is like gambling.
Yeah.
Yeah, no, it's because you were breathing through your mouth at the time and you didn't really truly understand what it was that you were doing. And then you teach your children and your grandchildren the wrong lesson about what it is to be an investor. And so if you don't have the stomach for any of that, just do what Drew said and invest in an ETF portfolio or see your financial advisor and they'll do it for you.
Yeah, and have a framework. All investing comes back to framework, like anything, so important should, and having a process. And it always helps to be writing it down. Like we've always talked about, if you've got a portfolio that you've held for 5 years, pull out a clean sheet of paper and what would you hold today from that? Sometimes all of it, sometimes probably nothing. But constantly second guessing and checking your process and what you're doing is incredibly important.
That's really important too because of your clients being in retirement. This is probably a zero tax environment inside their super.
Yeah.
If you're a little bit more sprightly, you might be thinking, well, you got to pay tax. So you can maybe do it over time, like a lot of property investors that are now getting into shares because of all land tax, borrowing costs, cross collateralization, all that stuff. That doesn't work anymore. So a lot of property investors are looking at shares and how shares can provide passive income. But the problem is you can't just go and sell all your properties at once because you'll have a big problem that you're going to crystallize a lot of tax. So you do that slowly over time, you stagger it, and so on and so forth. Now, we did have one really good question. And this question, you're going to have to bear with me, Drew, and dear listener, because it's quite a long question, but it deserves the fullness of the question. Siggy Butt Brain, Siggy Butt Investor says, aloha, Owen, Drew, and team. I think they forgot Andrew. As a bloke in their mid-40s that has been working in the health sector, remember that line. I have never had the opportunity or foresight to consider how to build financial stability or even vaguely consider investing. In brackets, I have struggled with numeracy and financial literacy over the years and it's all felt unattainable. I was also a heavy cigarette smoker up until 3 months ago. You may not have looked at the price of cigarettes now. Let's just say I'm able to save $350 a week on this activity alone. Yes, about 18K a year. What a golden opportunity, they say, Drew. And a far stronger motivator to keep it up. Yeah, it is great. In the past 6 months, I've gone from a small amount of debt to a portfolio just shy of 20K. And as I have been able to find additional savings in other areas of my budget, giddy up. I started out with the aim of just start and a commitment to learn as I go. I suspect, however, I have not been cigar butt investing, but more ciggy butt investing. That is, companies not that healthy, not working for my future interests, and the only thing growing is my curiosity to how to do this better. So, on to my questions. Number one, having started reading and listening to podcasts widely, so they say something about your voice is very soothing.
Thank you.
I have found the concept of GARP investing, that is growth at a reasonable price, really engaging, and it seems to align well with commonly accepted principles of investing in companies for the longer term. I would love to know what metrics that I, a great clinician but lousy finance guru, best use to determine what aligns with the GARP approach when determining which companies to invest in or to remove from my struggling portfolio. So let's start with that. There's another question which they'll go on with in just a sec. But Drew, GARP investing, how do you think that could be done? Happy for you to take this whatever way, whether it's through the lens of individual stocks or portfolio as a whole, or just describe the concept.
Yeah, I think it's quite unique because Jamie, my business partner, talks about GARP all the time.
Yeah.
But there's this, I think I'm reading, Josh Brown. So I'm reading his book at the moment. And he talks about this idea that every fund manager will say that they want to buy a reasonably priced stock. No one no one's going to go out and say, I want to buy the most expensive stock. They'll come and say they want to buy the cheapest or the reasonably priced stock. So in investing, fundamentally, you have value investing, and that's when Siggy Butt Brain was referring to cigar butt investing. And historically, value investing was finding businesses that had large tangible assets like property and machinery, and you could buy it cheaper. Historically, it's changed a lot. You could buy it cheaper than what it was trading on the share price, or you could assess a net tangible asset value to it. On the other side is growth investing. And when you're referring to growth, essentially you're trying to find companies that are going to continue to grow their earnings and their profits and their revenue at a pace that's larger than what the economy itself would give you. What you're saying in GARP is that it kind of lies a little bit between value and growth. So if you're a growth investor, you have to be comfortable paying like a 30 times price earnings ratio, so a multiple of 30 times last year's profit to own some of the fastest growing companies. If you're a GARP investor, you're looking at more, probably still expensive for a value investor, but more, as they say, reasonably priced, so less expensive on traditional metrics. And it can be, it's incredibly difficult because reasonable price is in the eye of the beholder. Everyone has their own models, everyone has their own inputs into models, and a slight change in those models means that your valuation and hence what you're willing to pay for it is significantly different to someone else. But I think it's so difficult to execute. But what you're looking for is, I think, a good way to explain it would be a flexible growth investor, like how we talk about flexitarians, or something like it's someone who understands growth, understands value, but isn't fully committed in either direction. And no one's really going to say that. They're never going to, very few come out and say they're GARP investors or they're not growth investors. So it's how do you find someone who's willing to adjust their portfolio as the market adjusts. I don't think there's a GARP ETF in Australia, is there? Oh, there is only one GARP ETF in Australia.
Yeah, it's just launched from Global X.
That's safe to say it's probably got a lot of just flat out growth companies in it.
I'm going to show you that now, Drew. Actually, if anyone that's watching, you'll get it. I'll walk you through it if you're listening. So, and by the way, if you're like, oh, those guys talked about something on the podcast.
That was me doing my best to explain it.
No, that's great. Yeah, no, you did very well.
But this is portfolio, and apart from that weighting in Berkshire, you're talking about growth.
Nvidia, Apple, Alphabet, Microsoft, Meta. But this is the thing, right? Okay, so growth at a reasonable price. Like you said, there's the value investors down one side. Yeah. They're smoking the cigars off the street, mind you. They're buying the dog stocks, the 52-week lows. That's where they party. But then you got the other people on the other end, which are more like the tech evangelicals, like the people that are like, oh, this new trend, AI, buzzword, look at this. The problem is that for a lot of people, and the way GARP investing rose was because people wanted to market their investment fund, but they didn't want to say that we're just starry-eyed people that invest in all these tech stocks, as you said. They want a little bit of constraint around the valuation. If you're familiar with Peter Lynch, we did an episode on this not too long ago. Peter Lynch was the kind of the official spokesman for GARP investing because he was like, invest in what you know, buy good companies, but pay reasonable prices. And he used to use the price earnings growth ratio, or the PEG ratio. But I'm just here looking in the Global X S&P World X Australia GARP ETF. So full disclosure, as many people will know, Global X is a sponsor of the Australian Investors Podcast. So that's the disclosure. They didn't know we're talking about this. I didn't know we're talking about this. So if you look at the holdings, there are 250 different stocks inside this ETF. They have a price earnings ratio of 17 and a price to book ratio, which is the share price compared to the value of the assets on the balance sheet, of 2.9. Now, if we jump to the NASDAQ ETF from BetaShares, which, full disclosure, is a sponsor of our finance podcast. This is the top 100 stocks, and there's no valuation filter applied. There's nothing in this ETF that says that stock's too expensive, have less of that. It's just purely what's ever in the NASDAQ 100. And here we can see that it has a price to book ratio of nearly 9 versus the Global X one of 3. The top holdings in this, Apple, Nvidia, Microsoft, Amazon, Broadcom, Tesla, those types of companies.
Weighted average market cap 2 trillion.
Yeah, weighted average market cap of 2 trillion Aussie. Yeah, so they're big. They're big boys.
But I think what I was going to say, if you looked at this, like the perfect explanation, I think, of GARP is the fact that Tesla isn't in the GARP ETF, but it would be a large exposure. I'm assuming it's in the Nasdaq.
Yeah, it's only 4%. It's only 4% of Nasdaq, and it's not in the top. It would be less than, even if it was in less than 1% of GARP.
Tesla and Amazon are traditionally companies that make big losses because they're pursuing high levels of sales growth, whereas Nvidia, Alphabet, Microsoft, Meta are generally churning out profitable quarters. And that's one of the big switches between the two, is that these are profit-focused businesses and actually delivering a profit versus the others. So I think they're really good examples of
what is GARP
would be different. Yeah.
Yeah, so you use those kind of valuation factors on top of the growth, which is, I didn't really explain it, but Peter Lynch's kind of big contribution was, other than being a phenomenal investor and just educating people, was the price earnings growth ratio, which is basically comparing the PE ratio, which is just like a very crude valuation metric, which is just share price divided by yearly profit per share. And it gives you a ratio like 10. But then he would compare that to the growth rate in profit to get the price earnings growth ratio. And so if it was like a 20% growth, for example, you compare that to the 10%, and there's your PEG ratio of 2, right? So you kind of get these types of ratios. And I think I got that the right way around. The PEG ratio became really popular with hedge funds and that sort of stuff. But you're just putting a filter on for the relating the quality to the growth, or the growth to the valuation. Now, there was a second part to this Siggy Butt question. Number 2, after a few failed attempts and rapid large dips, I have pivoted to a core ETF portfolio. In brackets, I hear you breathe a sigh of relief. But then they go on to say, and have about 50% of my portfolio in the Global X GARP ETF. It seems to be struggling to build momentum. Is this something I should be concerned about? Now, first of all, Drew, 50% in one ETF. I'll get you to respond to that. Second of all, they said it's struggling. I want to be very clear about what they alluded to for people that aren't aware. It's actually performed incredibly well straight out of the gates. But the thing is, where is the performance straight out of the gates? So obviously past performance is not indicative of future performance. It's only been out 3 months. It's up 16%. So it's performed incredibly well. Not to say that's going to continue. The thing that they're referring to is that it's only small in terms of the amount of money in there. There's only $10 million invested in this ETF, and they're probably all from the Rask community, to be honest. Would you be concerned about 50% in one ETF, Drew? That's the first question. Number 2, how worried do you get about the size of the money that's already inside of an ETF, generally speaking?
Yeah, I mean, generally, I'd be looking at more than one ETF, particularly when it's something that this is semi-active, because you're making an active call to move away from the index. So on that level of capital, I'd be trying to hold a bit more diversification, whether generally sticking to growth because you're young and you're pursuing growth. So I'd be looking to have a broader global exposure to different parts of the global economy, and also some Australian exposure at the same time. And I mean, you do have to think this is 50% is in 250 stocks.
Yeah,
so
you're actually, one thing.
You're more diversified than if you were buying the S&P 500, which is quite unique to think about. Generally, I think at least have 4, and particularly given these comments, if you're new to investing, it's going to be incredibly volatile, and you're going on one particular style. You want a diversification of styles and sectors.
Yeah.
And the other one, I mean, we had a fund close, inform us they were closing today.
Right.
I'm not too worried. And there was a list of about 10 or 20 late last year that beta shares and multiple groups had shut down. That doesn't worry me too much. I know when you're investing in ETFs and funds that are investing into listed assets, there's no problem. When they shut down, the assets are sold and you get your money back, or you've always got the chance to redeem them. And we know most of the time that's a commercial decision. So if this was still at 10 mil 12 months from now, then I'd suggest it would be looking to be shut down. but it's not going to impact. You're still going to get exposure to those same companies. This index still runs in the US, and it's not something that should worry you too much.
Yeah, I agree.
You're never going to be pissed off when it happens.
It's also an established ETF provider. If this was a smaller ETF provider with one ETF, and that one ETF hadn't done a good enough job of getting enough investors, then I would probably be a bit worried. The second thing is it's pretty much brand new. So these things typically at least last for, I don't know the full range of the BetaShares ones, but many of them, from my understanding, had been around for like 3 or 4 years before they decided to close them. The problem that people get spooked about with the closing of funds is when they're not in, as you said, listed assets. They can't just like get a notice and then sell it and be like, oh, whatever, I'll just pay the tax. But it's when they've invested in weird things like property or commercials type stuff. In terms of 50% in one portfolio, this is an interesting thing, Drew, and it's interesting that you say that it's more diversified than the S&P 500. That's got 500 stocks, but that one is all weighted to the biggest stocks. So that's the angle. That's the kind of salient point there. But I tend to get a bit worried when people have 50% in one ETF, and it's not why people probably think. It's because I think most people get really worried about anything that's a single figure. So I think a lot of people that have like diversified ETFs and that sort of stuff come unstuck in the years to come when they have bigger balances in one thing. It's like if you had one property versus 4 properties, you would feel more worried about the one property than having 4 diversified ones. And so I just think that when you have a portfolio and you have so many options, you can also use other expressions to capture a similar trade. And what I mean by that is like there's the Qual ETF from Van Eck, QUAL, that's invested in 150 of the world's highest quality companies. So you could blend GARP with Qual, with NASDAQ, with some like a small cap fund like Monroe, and you could get a really good portfolio at the end of it that still has similar long-term performance. But the road to get there, as you were saying at the very top of today's show, is very different.
Yeah, for sure.
Now, Drew, we do have to do formalities at the end of the show. One of the formalities is your dad joke, which I'll ask you for in just a moment.
Already got one ready for once.
I think Siggy Butt Brain, Siggy Butt Investor. It made me laugh when I read that before we started recording. I love that. And I love the question and the journey you took us on. I think they're all good questions, though. So if you are anyone that wrote into us today, just let me know. Shoot us a message on the Rask websites and we'll get in touch. Drew, real quick question for you there. What is the current wait time for someone to get financial advice through Wattle Partners?
We call you same day.
So you have capacity for people if they're listening to this and they want to get financial advice from you and the team?
Yeah. For context, we'll always give people a call within the week of contacting us, and that's kind of this client fit conversation is a good way to.
So you determine if you guys are going to work together.
Do they want what we can provide, and can we provide something that's similar to what they need? And given how much we talk about it, in most cases, a pretty good match. And then there's a bit of a process, so we have to know everything about people. So once we've got information, it's something like 4 weeks from all the information to getting a financial plan, and then being able to start talking about executing that and putting everything into place.
Okay. I just wanted to know because there's a lot of people that are still in this new year, new me camp, and we've seen some come through today looking for retirement advice. So if you are interested in getting retirement advice, be sure to reach out. There's a link in your podcast player in the YouTube description. Second note, which is more housekeeping for me. If you're a financial planner, if you're an associate, if you're looking to make a move into finance and you have a qualification, you should go and you should Google financial planning jobs because all of Rask is looking for team members, but so is Wattle and so is all of our other partners, James, Everest. Everyone's looking for talented people. So you can just shoot us a message or jump onto Seek and you'll probably find something there as well. All right, Drew, give us your dad joke.
I love telling dad jokes. They always make him laugh.
That's pretty good, mate.
Good one.
That's pretty good. You turned that around on me.
When I'm trying to search for these, you've got to be careful on Reddit. So
I'll take a lot of things on there. That's great, mate. Good one. I'll give you 7 out of 10. If you do want to send in some questions, you can send it to the link in your YouTube description or podcast player. There's a thing that says ask a question. It's also available on any of the Rask websites. If you scroll down the bottom, there's this thing that says ask a question, select the Australian Investors Podcast. We're getting bucket loads of questions for the retirement podcast. All y'all that wanted retirement content, you don't leave the Investors Podcast. Geez, stay with me. Send us your questions. We've got plenty of time. We're doing live shows and those types of things. You can also jump on social media. Drew from Wattle Partners. This is great chatting, mate. So thanks for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.